Hello friends. Welcome back to fourth part of Country Profiles session. So let's begin this class with the New Zealand. If you've seen The Lord of the Rings, then you probably know that Middle-earth is located somewhere along the hills of New Zealand. More than being home to Frodo Baggins and his hobbit friends, New Zealand is also one of Australia's next-door neighbours in Oceania, the southern region of the Pacific Ocean. The country is made up of two main islands, the North Island and the South Island, and several smaller islands. Famous for hosting a larger population of sheep than people, New Zealand is home to about 4 million residents. To put that into perspective, New York City alone had a population of 8.4 million people. New Zealand is also known as Aotearoa, which means land of the long white cloud in Maori, one of the major languages in the country. Let's look into New Zealand, facts, figures, and features. Here you can check. Neighbors. Size. Population. Density. Capital city. Head of state. Head of government. Currency. Main imports. Main exports. Import partners. Export partners. Time zone. Website. Let's come to economic overview. With its teeny-tiny population, New Zealand's economy is also relatively small. Its GDP, which is valued at $123 billion in 2011, ranks 65th among the world economies. But don't underestimate New Zealand. This country makes up for its size by being a strong player in trade. Their economic activity is largely dependent on trade, mostly with the land down under, Australia, the land of the rising sun, Japan, and Uncle Sam, US. It is an export-driven economy, with its main exports such as ores, metals, and wool comprising a third of its GDP. It also exports much of its cattle and dairy products. Angus beef sound familiar to you? Its primary industries are agriculture and tourism, and they only have small manufacturing and technology sectors. Because of that, its imports from other countries comprise mostly of heavy machinery, equipment, vehicles, and electronic products. Since the country has removed many barriers to foreign investment, the World Bank has praised New Zealand for being one of the most business-friendly countries in the world, second to Singapore. Monetary fiscal policy. The Reserve Bank of New Zealand is in charge of the monetary and fiscal policy of the nation. Currently headed by Governor Alan Ballard, the RBNZ holds monetary policy meetings 8 times a year. The RBNZ is tasked with maintaining price stability, setting interest rates, and monitoring output and exchange rates. To achieve price stability, the RBNZ must ensure that annual inflation meets the 1.5% central bank target. Otherwise, the government has the right to kick the RBNZ governor out of office. We're not kidding. The RBNZ has the following tools in its monetary policy arsenal. The official cash rate, which affects short-term interest rates, is set by the RBNZ governor. By lending 25 basis points above this rate and borrowing at 25 basis points below the OCR to commercial banks, the central bank is able to control the interest rates offered to individuals and businesses. Open market operations are used to meet the cash target or the amount of reserves parked in commercial banks. By forecasting the cash target daily, the RBNZ is able to calculate how much money to inject in the economy in order to meet the target. Getting to know the NZD. The New Zealand dollar is nicknamed Kiwi. It's a bird. It's a plane. No, wait, it's really a bird. The Kiwi also happens to be the national symbol for New Zealand. But let's focus on the Kiwi as a currency and its interesting characteristics. Show me the commodities. Since New Zealand's economy is mostly dependent on its exports of commodities and agricultural products, the overall economic performance of the region is linked to commodity prices. If commodity prices rise, then the amount of money paid for New Zealand's exports also rises, which then makes a larger contribution to the country's GDP. Since a higher GDP reflects a strong economic performance, it could lead to an appreciation of the Kiwi. Conversely, falling commodity prices result to lower monetary value of exports, making a smaller contribution to GDP. A lower GDP could then cause the Kiwi to depreciate. I move hand in hand with the AUD. Since Australia is New Zealand's #1 trade partner, the economic performance of Australia has a huge impact on New Zealand's. For instance, when the Australian economy does well, Australian firms pump up their importing activities, and guess who benefits from that? New Zealand, of course. And, just like the AUD, I enjoy carry trades. Just like Australia, New Zealand enjoys higher interest rates compared to other major economies, such as the US, the UK, or Japan. Interest rate differentials between economies often serve as indicators of money flows. Since investors prefer to receive higher returns, they'd sell lower-yielding investments in exchange for higher-yielding assets or currencies. In other words, the higher the interest rate, the more money flows in. I'd like more migration, please. Because New Zealand's population is less than half the number of people living in New York City, an increase in migration into the country has a huge effect on the economy. This is because as the population grows, the demand for goods and overall consumption increases. Oh, I'm weather sensitive too. New Zealand's economy is also largely driven by its agricultural industry, which means that severe weather conditions such as droughts have a huge negative impact on their entire economy. Those heat waves are also prevalent in Australia, which is more frequented by forest fires, costing close to 1% of its GDP in damages. This doesn't do the NZD any good. Important economic indicators for the NZD. Gross domestic product. Just like any other nation, the gross domestic product, GDP, serves as an economic report card for New Zealand. By serving as a gauge of overall economic performance for the New Zealand, it influences the demand for the NZD. Consumer Price Index, CPI. The Consumer Price Index measures the change in price levels. As a measure of inflation, it is closely watched by the RBNZ in determining changes in monetary policy. They're supposed to maintain price stability, remember? Balance of trade. Since New Zealand is an export-driven economy, traders often take a look at their trade balance to gauge the international demand for New Zealand's products. What moves the NZD? Economic growth. Positive GDP growth reflects the strong economic standing of New Zealand, boosting demand for its currency. Negative GDP growth highlights the poor economic performance of the country, dampening demand for the NZD. Surge in exports. Higher demand for New Zealand's products often results to a higher GDP, which then boosts the NZD. In contrast, lower exports make a smaller contribution to GDP, causing the NZD's value to fall. Rising commodity prices. Increasing commodity prices causes the monetary value of New Zealand's exports to rise, pushing its GDP higher. Falling commodity prices, on the other hand, cause the monetary value of exports to fall, dragging its GDP down. Trading New Zealand dollar to US dollar. Since the counter currency is the US dollar, the changes in value are measured in greenbacks. On a 100,000 unit New Zealand dollar to US dollar position, each pip movement is worth 10 US dollars, while on a 10,000 New Zealand dollars USD position size, each pip movement is worth 1 US dollar. Margin calculations are based in US dollars. For instance, if the current NZD-USD rate is 0.7000 and leverage is 100 to 1, 700 US dollars in available margin is required for a 100,000 New Zealand dollars position. A 10,000 New Zealand dollars position requires 70 US dollars in available margin. You see, because of the Kiwi's relatively low value against the US dollar, it requires the least amount of available margin among the other majors. That means it's cheaper to trade the Kiwi. New Zealand dollar to US dollar trade tactics. Strong economic reports from New Zealand result to an appreciation of the NZD, so if there's a good chance that an economic release could beat the consensus, it could be a sign to go long New Zealand dollar to US dollar. Weak economic reports, on the other hand, push the NZD down. If an upcoming report is likely to come in weaker than expected, it could be a chance to short New Zealand dollar to US dollar. Aside from watching economic reports, taking note of commodity price behavior could also serve as an influence on New Zealand dollar to US dollar price action. In recent history, commodity prices tend to surge when demand for riskier assets is also strong. During these times, investors place their money in higher-yielding assets such as gold and other commodities and sell the lower-yielding US dollar. As a result, the commodity-based Kiwi gains strongly against the safe haven US dollar. On the other hand, when risk aversion forces investors to flee back to the safe havens, the NZD edge is lower against the USD. Just like the AUD, the NZD is also a good candidate for carry trade. Since carry trades involve buying of a currency with high interest rates and selling of a currency with low interest rates, New Zealand's relatively high interest rate provides support for the NZD. Let's move to another lesson. Switzerland. Switzerland was founded in 1291 and is located in the middle of Western Europe and shares much of its history and culture with Germany, Austria, Italy, and France. Although being right smack in the middle of Europe, Switzerland is not part of the European Union. While there were talks between the EU and Switzerland in the mid-1990s, the Swiss public rejected the proposal to be part of EU. Since then, Switzerland has maintained its economic independence. Switzerland is considered to be a small country, but let us tell you that it is packed. It has a population of about 7.78 million, with around 477 people per square mile. Switzerland is also known for its neutrality as it has refrained from participating in either of the two world wars. Have a look into Switzerland, facts, figures, and features. You can check here: neighbors, size, population, density, capital city, President of the Swiss Confederation, currency, main imports, main exports, imports partners, exports partners, time zones, and website. Let's come to economic overview. Switzerland is one of the richest countries in the world in terms of per capita income, that's total GDP divided by the country's population. In 2010, it produced $529.9 billion in total output. As small as it is, on a per-person basis, it boasts of a GDP of $46,815, which is seventh highest in the world. Its main trading partners are Germany, the US, France, Italy, Austria, Russia, and the UK. Like Japan, Switzerland is also highly dependent on its exports, which make up about $308.3 billion or 58.2% of its GDP. Switzerland's main industries are machinery, chemicals, textiles, precision instruments and watches. Don't laugh at that last one, it actually comprises a decent chunk of Switzerland's output. Anyway, it's time to move on. Monetary fiscal policy. The Swiss National Bank, SNB, which is presently chaired by Mr. Thomas Jordan, conducts the nation's monetary policy by influencing the country's monetary and credit conditions. The governing board, which is responsible for determining the bank's policies, consists of 3 members, the chairman, vice chairman, and a third member. That's right, only 3 people are part of the board. Unlike most central banks, the SNB sets a target range for its desired interest rate, also called LIBOR, rather than a fixed figure for 3 months. On top of its purpose to control the country's money supply and influence interest rates, the SNB has a more on-hand role in keeping the CHF's valuation stable. An excessively strong CHF could cause inflation to spike and could also undermine the country's exports. With Switzerland's strong reliance on their exports, the SNB favors a weaker CHF and does not hesitate to intervene in the forex markets to weaken it. One of the major monetary policies of the SNB is inflation targeting. The bank's inflation target, which is monitored in the CPI, is below 2% a year. The bank will then attempt to influence the country's actual inflation rate through open market operations and by adjusting the LIBOR rate. Speaking of open market operations, the bank influences the LIBOR rate through short-term repurchase, repo, transactions. A repo transaction involves selling of a particular security for cash and agreeing to repurchase the same security at a later date. If the interest rate in the open market rises over the SNB's desired band, the central bank will supply the other banks with more liquidity through repo operations at lower repo rates. On the other hand, the SNB can reduce liquidity by increasing the repo rate, eventually increasing the LIBOR rate as well. On the fiscal side, one attractive fiscal policy that Switzerland has is that they have some of the lowest tax rates among developed nations. In fact, it is often referred to as a tax haven nation. Corporate tax rates in Switzerland run from 8.5% to 10.0%. This, in addition to its bank secrecy laws, makes Switzerland one of the most business-friendly nations in the world. Getting to know the CHF. Not too long ago, France, Belgium, and Luxembourg also termed their currencies as francs. Until they adopted the cooler euro, that is. At present, Switzerland is the only one using the franc as its currency, the Swiss franc, CHF. Among financial geeks, the Swiss franc is known as the Swissy. Thanks to Switzerland's neutrality. Switzerland is considered to be politically neutral due to its bank secrecy laws, giving the CHF a safe haven status as well. Usually, during times of economic uncertainty, investors move their funds into Switzerland, causing the CHF to gain in value. I'm still stuck in the bling-bling era. Not only do the Swiss refuse to join the cool kids of the EU, but they are also the only country that still adheres to a gold standard. About 25% of the country's money is backed with gold reserves, giving the CHF a 80% correlation with the price of gold. This means that whenever the price of gold rises, the CHF could stand to benefit as well. Important economic indicators for the CHF. GDP, the gross domestic product, GDP, is the measure of the country's total value of all final goods and services. The report gauges the change in the economy's total output from the previous period. Retail sales, the headline retail sales report measures the monthly change in the total value of sales at a retail level. Consumer Price Index, the CPI measures the change in the prices of a basket of goods and services. The CPI is followed closely by the SNB, as it uses the report to help in its inflation analysis. Balance of trade, the balance of trade measures the total difference in value between exported and imported goods in the country. Switzerland has a very robust export industry, so traders often use the country's trade balance to measure how well the economy is faring. What moves the CHF? Price of gold. As mentioned earlier, the CHF has an 80% correlation with the price of gold, as 25% of Switzerland's cash is backed with gold reserves. When gold prices go up, the CHF usually goes up as well. Conversely, when gold prices slide, the CHF likewise declines. Developments in the Eurozone and the US. Since Switzerland is an export-dependent country, it is vastly affected by the economic development of its major trading partners in the Eurozone and the US. Switzerland's major export partners in the Eurozone are Germany, 21.2%, France, 8.2%, Italy, 7.9%, and Austria, 4.5%. The US, meanwhile, takes about 8.7% of Switzerland's exports. Poor economic performance in any of these countries could mean less business for Switzerland. Sorting out the rough edges. Political tension in its neighbors in Europe, particularly in the Eurozone, could cause traders to seek the safety of the Swissy. Remember that the Eurozone is a brood of 16 states, with the ECB directing and implementing a set of monetary policies for the entire group. Given that the economies of the member countries grow at different paces, ECB policies sometimes go against what a single nation needs at that specific time. The X factor. US dollar to Swiss franc is also affected by the cross-exchange rates like euro to Swiss franc. A jump in the euro's valuation due to a hike in the ECB's interest rate, for example, could spill the Swissy's weakness onto other currency pairs like US dollar to Swiss franc. Merger and acquisition activities. Switzerland's main industry is banking and finance. Merger and acquisition activities, or simply the buying and selling of firms, are very common. How can this affect the spot prices of the CHF? For example, if a foreign firm wishes to acquire a business in Switzerland, it will have to pay for it using CHF. On the other hand, if a Swiss bank, for example, wishes to purchase a US firm, it will then have to dump its CHF for the USD. Trading US dollar to Swiss franc. US dollar to Swiss franc is traded in the amounts denominated in USD. Standard lot sizes are $100,000 while mini lot sizes are $10,000. The pip value, which is denominated in CHF, is calculated by dividing 1 pip by US dollar to Swiss francs rate. Profit and loss are denominated in Swiss francs. For one standard lot position size, each pip fluctuation is valued at 10 Swiss francs. For one mini lot position size, each pip fluctuation is worth 1 Swiss franc. To illustrate, if the prevailing market rate of US dollar to Swiss franc is 1.0600 and you want to trade one standard lot, then 1 pip would be equivalent to 9.4340 US dollars. Margin calculations are typically in USD. At 100 to 1 leverage, you need $1,000 to control 100,000 units of US dollar to Swiss franc. US dollar to Swiss franc trading tactics. The Swissy pairs, US dollar to Swiss franc and euro to Swiss franc, are usually active during the European trading session only. Both currency pairs tend to be range-bound most of the time. Given this, they are mostly susceptible to sudden spikes and breakouts. As we mentioned earlier, the SNB is very much keen on monitoring the valuation of the Swissy. It is notoriously known to intervene in the forex market to weaken the CHF, especially when it reaches some historical key levels. For example, if US dollar to Swiss franc falls back to its yearly low due to an increase in risk appetite, the SNB could just be lurking around to push the pair back higher. You could also trade the Swissy by monitoring the economic fundamentals of its major trading partner, the Eurozone. Any economic or political tension in the Eurozone could lead investors back to the safety of the Swissy. Given this, currency crosses like euro to Swiss franc could also be used to trade, for example, the US dollar to Swiss franc. A rate hike by the ECB which boosts euro to Swiss franc could also spill over on US dollar to Swiss franc. Now let's come to the last country profile. China. Welcome to the grown-ups table, China. If all you know about China is that it has the world's largest population and Great Wall, then you need to read up, playa. China was first recognized as a unified country back in 221 BC, ruled by the Qin dynasty. No, big, fat pandas weren't kung fu masters back then, at least we don't think so. Since that time, we've seen many dynasties rise and fall until the People's Republic of China was established in 1945. It wasn't until recently, though, that China emerged as a legitimate world power. It boasts world-class cities, Olympic gold medalists, and delicious dim sum. Not only is it the birthplace of Yao Ming, it even became the third nation to send a man to space. From sports to space travel, to economic might, China is slowly crawling its way up the leaderboards. Look into the China, facts, figures, and features. Here you can check. Neighbors. Size. Population. Density. Capital city. Head of government. Currency. Main imports. Main exports. Imports partners. Exports partners. Time zone. AMP, website. Here we have economic overview. In late 2009, China overtook Japan as the world's second largest economy, and as of 2011, China's GDP stands at a massive $7 trillion. It wasn't always this way though. For the longest time, China's economy was secluded from the rest of the world. It was only during the formalization of the modern government, the People's Republic of China, that China started opening its door to the rest of the world. China hit a humongous growth spurt in the 1990s and 2000s, as the nation posted ridiculous double-digit growth. This put its booming economy at the forefront of emerging market growth. Interestingly, the growth has been spurred on by the agriculture and industrial industries, which account for more than 60% of the total GDP. Export trade has also played a major factor, with the undervalued yuan helping make Chinese goods more attractive in international markets. Over the past year though, there have been fears that the Chinese economy may overheat. To counter this, the Chinese government has implemented various monetary and fiscal policies to ease the transition to more sustainable growth levels. Monetary AMP, fiscal policy. The People's Bank of China, which is located in Beijing, is in charge of China's monetary policies. Aside from controlling interest rates and reserve ratio requirements, the bank is also tasked with regulating financial institutions in mainland China. Now here's a little piece of trivia for you. Did you know that the bank currently holds the most financial assets among all the public financial institutions in existence? It is currently holding over $1.3 trillion USD worth of treasury bills, and not to mention all the other bonds from other countries that's on its balance sheet. This shouldn't be too surprising considering how China managed to trump most nations in terms of economic performance. Another interesting factoid about the bank is that its interest rates used to be divisible by 9 instead of 25 a few years back. This was because the Chinese based their rate system on the abacus, which was set in multiples of 9. Can you imagine reading about a 0.18% hike in benchmark rates? Recently, however, the bank decided to let go of this traditional practice and adopt the convention of hiking or cutting interest rates by 0.25% increments. In fact, the bank is pretty notorious for making aggressive interest rate changes depending on how the Chinese economy is faring. Aside from the interest rate, the bank also has the ability to adjust the reserve ratio requirement, RRR, for banks in its monetary policy arsenal. You see, the RRR refers to the amount of cash Chinese banks are required to hold in their vaults. By varying the ratio, the buck is able to control how much money is in circulation and keep inflation within their target levels. Getting to know the CNY. The yuan is the primary unit of Chinese modern currency or renminbi. If you're constantly getting confused between yuan and renminbi, just as Dr. Pipslow often mistakes sugar for salt when making his morning coffee, all you have to remember is that the term renminbi is the official name of China's currency while yuan refers to the actual units. Although China is in the midst of reforming its exchange rate policies, the yuan still remains pegged to the US dollar. This means that if the US dollar rises or falls in value, the yuan follows accordingly. As such, CNY isn't one of the commonly traded currencies in the forex market. Important economic indicators for the CNY. GDP. This figure acts as China's economic report card because it reflects how much their economy expanded or contracted for the period. CPI. The buck keeps a close eye on the Chinese CPI report because it reflects how much price levels have changed over a particular period of time. Trade balance. A huge chunk of China's economy is comprised of international trade, which means that the trade balance is typically considered a leading indicator of growth. Buck interest rate decision. As we mentioned earlier, Buck is notorious for making aggressive monetary policy changes whenever they feel that the Chinese economy is overheating or if it needs more stimulus. Trading the Chinese economic reports. Even though the yuan isn't a commonly traded currency, that doesn't mean you can't make any pips off those Chinese economic releases. Because China's economy is so ginormous, its economic events will most likely impact those nations that they are closely associated with. One of these is Australia. China is Australia's largest trading partner, with the two nations exchanging nearly $100 billion worth of products each year. With that, Chinese economic data releases tend to impact the Australian dollar the most among the major currency pairs. Lastly, come to the trade tactics. If you watch the Australian dollar just like our Comdol Queen Happy Pip, then you should definitely mark your calendars for Chinese economic releases and buck statements. More often than not, better than expected economic figures from China lead to an Australian dollar to US dollar or Australian dollar to Japanese yen rally, while weaker than expected results usually trigger an Aussie sell-off. Buck rate decisions are a little more tricky as these depend on prevailing market sentiment, so it's best to do your homework and read up on Forex Gump's economic analysis articles to be in the loop. So guys, final country profiles course has been completed here. As well as undergraduate, sophomore session is finished here. In next video we will start a new session, which is undergraduate, junior. So stay tuned.